Everything you know about a balance sheet is wrong, brought to you by shoes, a vase, and a $5 bill. What does this have to do with the balance sheet? So as you might know, or probably know, a balance sheet is a list of your assets, liabilities, and equity. And sometimes people really confuse the three of them. And they think, oh, liabilities are bad or wrong, or equity is where the value is held in a company. And so I want you to dismiss those thoughts that you've had about the balance sheet, and we're going to talk about shoe finance. We're going to call this shoe finance. So I want you to think about an asset list of a company. So let's say we go into business and we bring in $5 of our own money to start the company. So there's our first $5. That is owned by the company. The company itself owns that $5, right? In a publicly traded company, the shareholders themselves own that $5. No one else has claim on that. The company itself has claim on that. So that is an equity claim. So I want you to imagine that this is the asset right here. These are the items in the asset list. This is the claim. Who has claim on that asset? Because the company itself has claim on that asset, this is an equity claim ticket. Just like if you put your coat when you go to the fancy restaurant and they take your coat and they give you a claim ticket, here's your claim ticket right here. Equity means the company itself has claim on that asset. And so the equity for this is $5. The equity would also say, the claim ticket would also say $5. So here we have an asset and we have a claim ticket, and they match. $5 equals $5, right? Now the company is up and running and in business, and we need to purchase a shoe. Maybe this is inventory. Maybe this is a shoe store. We need to purchase some inventory. We don't have money to purchase that inventory. So we need to go to the bank and get money to purchase that inventory. And so this is gonna be also a claim ticket. And these shoes, I think they're TJ Maxx specials, honestly. I don't think they're that expensive. Let's say $50 for the shoes. Liability. This is now a liability claim ticket. Someone else, another entity besides the company itself, has claim on this asset. And so this is a liability claim ticket. The company still owns the shoe. The liability doesn't own the shoe. The company owns the shoe, but the liability has a claim on that shoe. And so that's the distinction between equity and liability. Liability is any other entity has claim on that asset besides the company itself. Some people think, oh, liabilities are bad. They're bad. We should get rid of those. Liabilities are bad. That's not the case at all. What if a customer has a liability or claim on some money that the company has? For example, what if a customer said, do you know what? I just want to pay for 10 years of your product or service upfront. Would we as a company have a problem with that? We'll take your money. That's no problem. If you want to pay for our service for 10 years up front, sweet, we will take that. And so what would happen in that situation is we would have the asset, the cash, but we don't have claim on that cash yet. We haven't earned it yet, right? It is a customer liability because the company does not have claim on that cash. Slowly, that cash would be earned every year or every month or every quarter. We would release money to ourselves. We would take this claim ticket and we'd say, okay, this is now an equity claim ticket instead of a liability claim ticket, a portion of it anyway. But in the beginning, if that customer pays 10 years up front, that's a liability. And that's a good reason why liabilities are not bad. You can't just say, oh, liabilities are bad, right? Customer liabilities, awesome. It means you got paid up front. So here's an example of a liability, and here's your liability claim ticket. Again, there are only two types of claim tickets: an equity claim ticket, the company itself has claim; a liability claim ticket, any other entity besides the company itself has claim. And so then let's say we're up in business, we're running, and we decide that we want to buy some office equipment like this lovely vase here. From Home Goods for $14.99. So here's an equity claim ticket. This is a $15 vase right here. And now we have a claim ticket on that vase. Now it doesn't make sense to have assets floating around with no claim tickets. All of the assets must have claim tickets with them, right? It also doesn't make sense to have equity floating around with no asset attached to it. Every asset has to have a claim ticket attached to it. And this is why it's called a balance sheet. If you add up the value of all your assets, it has to equal the value of all your claim tickets. Claim tickets is not a financial word, I'm just using it, but claim tickets in this sense is liabilities plus equity. The value of your liabilities plus your equity has to equal the value of your assets because liabilities and equity are just claim tickets on those assets. So you might be wondering, how are these assets valued? They are valued on the asset list, on the balance sheet, by how much they were acquired for. So if we bought this vase for $15 and Picasso himself came in here and painted a picture on it, it's no longer worth $15, right? We improved on the value of that. Oftentimes we just record on our financials though what we actually paid for it, not the perceived value or the updated value. And there's different reasons why you'd update your financials, but generally on a balance sheet, it's what you acquired the asset for. The last thing I want to talk about, where people misunderstand the balance sheet sometimes, is they think the value is held in the claim tickets. They say, ooh, look at all this equity I have. This is amazing. This is where the value is. No, the equity is just a claim ticket. This is where the value is. The value is held in the assets of the company. The equity or liabilities simply points to who has claim on those assets, but the value is held right here in the assets. And that is shoe finance.